The euro is lower against the US dollar this morning on the back of some pretty woeful PMIs from across the euro area. We had PMIs as low as 10 when you consider that 50 is the cutoff point between growth and contraction. Just highlights how severe the situation has become. Now, we haven't seen quite the negative reaction that we saw in the UK yesterday. While the UK was ever so slightly better, in the UK, the services sector accounts for just over 80% of the economy. In many of the major economies in the euro area, it is slightly less than that, with other sectors making up more of the share, including manufacturing. But it is also still desperate times as far as the region is concerned. It has passed the peak of coronavirus, and we are seeing early signs of reopening in certain economies, particularly those worst hit by the coronavirus, such as Italy. But there are still desperate times ahead. That was really highlighted by the European Commission economic growth forecasts, which were released alongside these PMI readings this morning, which again just pointed to the dire situation which we have in the euro area as well as the rest of the world. They highlighted that they see a 7.7% annual contraction this year across the region. That is the sharpest contraction since the Great Depression almost a century ago. They also pointed to vanishing inflation, ballooning deficits, which will add to the debt load that we already see across the euro area. And as always, the worst cases do seem to fall on those less able to take them. Again, we look at Italy, which already had a debt to GDP ratio around 140%, was struggling to see any growth, has been the worst hit country in the euro area, and it's expecting to see its debt to GDP grow up to around 100 or just shy of 160% of GDP. Other countries badly hit by this are the usual suspects, the Greece's and Spain's of this world. Again, it seems that the worst of this falling on those least able to take it. So it has taken the shine off the euro a bit this morning, adding to yesterday's losses, currently trading around the 108 level. And as you can see on the chart here, a few interesting levels above and below. Just below here, we've got around the 107.50s. I think that's the next line in the sand here. If that breaks, we could see more pressure piling on the single currency. And we have seen the US dollar bouncing back again these last couple of days. The dollar index just above the 100 marker. So again, it looks like more downside pressure is potentially building on these currencies as we start to continue to see the devastating impact of the coronavirus and the data and all of that is having. One potential upside for the single currency could be the fact that we are seeing improvements in risk appetite. We are seeing signs of reopening across the region as well as other countries around the world, and this is going to be crucial if some of these countries are going to economically bounce back. And again, I'm pointing primarily to the worst hit there, the likes of Spain and Italy, where we are seeing early reopening signs, but also the harshest shutdown measures. If we do see more and more of that reopening, then that could potentially lift risk appetite. It could potentially lift the euro currency. But again, in the near term, we could continue to see that under pressure. And until we see that downtrend change, I do feel like the levels below here are looking particularly vulnerable. If we do see the next level below here, 107.50 break, then again, that draws attention back to the 106 level roughly that we saw it drop to not too long ago. And 105 is always seen as an important line in the sand here as well, as far as this particular currency pair is concerned. If we can see a bounce back here, the 109s look quite interesting. If we can break above here, it would end the series of lower highs in this particular currency pair and could potentially lift the mood. But as I say, while equity markets are bouncing, while we are seeing risk appetite improving elsewhere, we're not necessarily seeing it in these particular currency markets, and the dollar continues to be well favored, even if it has come off its high. So I think we're going to have to see more improvements. There is a lot more data still to come this week, and I think that US jobs report on Friday, possibly or probably the worst jobs report we are ever going to see in our lifetimes, that could cause a shift in sentiment. So that's certainly going to be one to watch and keep the volatility very much there in this currency pair.